Thanks for joining us on lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Meera Dugal. Let's get you the headlines. Indian markets extend losses on weak global cues. Banking and metal stocks worst hit in trade today.
The 3-month US Treasury yield drops below the 10-year rate, triggering concerns of a recession.
The Jet Airways board is meeting today to decide on Naresh Goyal's fate as the chairman of the airline.
Special counsel Robert Mueller did not find evidence of Donald Trump colluding with the Russians during the presidential campaign.
Let's first take a look at how markets are faring. Darshan is here with us.
So it's extremely weak at this point of time. If you're looking at what's happening as far as the broader markets are concerned, obviously there is consolidation. The Nifty is down over 120 points at this point of time. The Sensex is down 400 points and the Nifty Bank is down over 350 points in trade. If you're looking at most of the sectors, they're trading with losses. In fact, all the sectors are trading with losses. The only one that is managing to hold on is the oil companies, which is flat in trade. The VIX has jumped up by almost 3%, but heavy selling is seen in the metal space, the PSU banking space and the FMCG space. So there is enough selling that's happening. Surprisingly, two counters which have managed to surprise the street and move in much higher are REC and PFC. Obviously, the deal is complete in terms of, PFC buying out REC. So REC is up almost 10% at this point of time, and Power Finance Corporation has moved up 7%. Jet Airways will be in focus today. A lot of news and speculation regarding the board meet today. Obviously, Jet Airways has managed to move up almost 3% in trade. And what keeps going in higher are the oil marketing companies. So IOC is up 3%. BPCL, HPCL, ONGC is doing well in trade, and among the other pharma names you have Divi's Lab, which continues its good run, which is up almost at the 1700 level in mark today. What is not doing well, Vodafone Idea continues to bleed. It's down almost 6% at the 30 level. Reliance Communication, the ADAG group stocks are not doing well, and DLF, the real estate rally seems to have fizzled out. DLF is down 4%.
Interesting that, Darshan. Here's a slightly bigger picture of what's happening to the broader markets. The sharp correction comes after an 8-day rally for the Indian equity benchmark. Sensex rebounded 8% from February lows, with more than $3.8 billion of foreign inflows coming in March alone. The question that's being asked is, was this too much too soon? Bloomberg News has compiled a few charts that give you a signal of the overheating that perhaps the overheating that's taking place. Let's start with the RSI first. This is the relative strength index of the Sensex, which very clearly shows on the right-hand side corner that the Sensex is marginally above in the overbought territory. Anything above the indicator of 70 indicates overbought, and that's where the Sensex is. The second one, and perhaps an insightful chart that's showing, is that the stocks are trading about 5% above their short-term average. This is the 50-day moving average in comparison, and it's very clearly trading at above the short-term average, 5% above the short-term average. The third one is a proprietary Bloomberg indicator, which is the greed and fear indicator, and the indicator shows that clearly greed is dominating Indian equities by most since 2009. That's comparison to the last election. So greed seems to be sort of much higher at this juncture as an overall indicator. The last one is from a valuation standpoint. You are seeing the Sensex P trade well above the 5-year average. This is the 12-month forward price to earnings ratio. That's how the benchmark index, that's also showing much higher than the 5-year average era, indicating that we are at some point showing signs of overheating. This is, of course, purely from the $3.8 billion that has flown in the month of March.
Right, Harsha, interesting charts there. Now, our market veterans will always argue that even within an overheated market, perhaps there are segments that they can look at. And one such segment, according to Pramod Gubby of Marcellus Investments, is consumption. Hear him out on why he thinks that's still a good bet.
Certain sectors naturally lend itself to better ROCEs, particularly consumer, tech and pharma historically. But consumer certainly, because the nature of demand in these sectors have been relatively stable. They're not that volatile. And these sectors have lent themselves to building a moat around themselves through brand and distribution network. Although, arguably, it's becoming harder and harder to defend yourself through brands, because social media is allowing new brands to come up fairly quickly. Distribution, you can put your products on an Amazon or Flipkart overnight and get access to distribution across the country. But having said that, they still remain one of the sectors where you see companies generating ROCs north of not just 15%, which is the cost of capital in the country. We've seen the Levers and Colgates of the world with 100% ROCs. So consumer generally is a...
But then that's the dichotomy, right? Because on one side, when you're saying you won't look at valuations, but they're steeply valued. But at the same time, they're also giving you that high ROC. So you tilt it in favor of the ROC instead of the valuation.
Absolutely. Although I would argue that in Levers and Colgate case, the growth is not clear, right? Growth is not obvious. So we would look for ROC as a starting point, and then with a little bit of growth opportunity, I think you can easily overcome the valuation issue. Like I said, 3 years of compounding at 15-20%, valuation multiple becomes irrelevant because the multiple itself doesn't compound over time.
I have a follow-up to that. Two-part question. One, are there enough opportunities in the listed space which are smaller in nature and therefore higher growth in the consumption space available? And two, how easy it is to extrapolate growth for these companies? Because as one of the CEOs of a large FMCG firm was telling me that while these new age fancy names with higher returns and arguably higher growth trajectory took center stage for a while, they found it extremely difficult to expand beyond the 3 or 4 or 5 metros. A lot of these brands have tried and then, as he said, thug gaye.
True.
So my question is, in the listed space, are these opportunities available in the consumption space?
Yes, they are. In fact, like you said, expanding distribution is not anybody's cup of tea, particularly in the shorter term. So that remains a longer term edge. But more importantly, I think generating internal efficiencies at the operational level. Pricing power need to be looked at in an inverse way, where even your ability, or rather your ability to grow your margins without having to take price hikes is perhaps a more sustainable competitive advantage than exercising the power of your brand to take price hikes, because price hikes allows competition also to take price hikes and breathe more freely. Whereas if you're generating your margin expansion through operational efficiencies and keeping the lid on the prices, then you're sort of suffocating your competition, and that's a much better, much more sustainable competitive advantage. But having said that, I think you question about the listed universe offering these opportunities very pertinent. As we wrote in a note a couple of weeks ago, increasingly economic activity in India is moving away from the listed market, right? So you see the participation of multinationals, participation of private equity and venture capital, SoftBank funded pretty much everything you and I use on a daily basis, be it the ride-sharing companies or the Amazons and Flipkarts, are not exposed to the listed market. And look at our own consumption basket. Quite a lot of that, particularly electronics, is all imported stuff, right? So there are no companies which are manufacturing goods incrementally which are part of the listed universe, nor at the distribution and the services level.
Not at the ancillary levels either.
Nor at the ancillaries. There are, of course, some of the smaller cap companies which are feeding into the growth of these companies. But by and large, the ability for Nifty or the Sensex to reflect economic activity is dwindling day by day.
All right, let's look into the currency as well. Along with the equity markets, the currency has also rallied. So since the start of about Feb, when you saw flows come back into the equity markets, you're up about 4%. If you're taking it from the lows that were hit in October, you're up actually 7-odd%. Now, it's a no-brainer to say that it's the portfolio flows which have driven this upside on the currency. It started with, of course, equity flows, which have been extremely strong through the month of March and in February. Debt flows were a little bit slower to catch up, and debt flows are now adding up to about 10,000 crore in the month of March after being sellers on January and February data. Now, we would like to argue that some of this gain that we're seeing on the rupee is fickle. The rest of it is slightly fundamental driven. And while it's the equity which has taken the rupee up to these kind of levels, it's the debt flows which actually are more fundamentally supportive of the Indian currency. The reason we say that is because what's been happening in the global bond markets, you've seen yields both on the US 10-year and the German 10-year come off quite dramatically. Germany trading below 0% once again on some of their benchmark bonds. The point simply here is that in India, despite being in a monetary easing cycle, you're still yielding about 7.3, 7.4 on the benchmark bonds. And if the currency is stable, then the yield differential story is very attractive for investors to come in to the Indian markets. That's one factor which is supportive on a fundamental basis of the Indian currency. There are others which are starting to turn. Remember, last year we were worrying ad nauseum about the current account deficit. Now, not to say that all the news on the current account deficit positive, but there are some things that are starting to change. Oil prices are moderate compared to last year's levels. So we've seen the trade deficit narrow to about $9 billion in the latest print that we saw on the data. Plus, of course, on the capital account side, things are looking better because of the portfolio flows, but also because external commercial borrowings from Indian companies have started to pick up. The RBI has changed rules there, widened the pool of borrowers, widened the pool of investors. So ECBs are expected to be strong in FY20, as is some money that is likely to come in from NCLT accounts, which are starting to get resolved. So those will also continue to perhaps be supportive of the Indian rupee. The final 2 points are slightly theoretical, but important in any case. The real effective exchange rate in India, which was looking very overstretched, at least until last year, has corrected substantially at about 112 on that index, given that you're a net importer. The rupee is not looking all that stretched anymore. And then the final point to make, which is perhaps not showing up in the currency right now, retrospectively, we'll know whether this is actually becoming a support for the Indian rupee or not, is the fact that our inflation scenario has changed dramatically. From years of 9% and very volatile inflation, we are now down to less volatility in inflation and within at least a 2 to 6% band, which is the MPC's target band. So the question I'm asking is, do those narrowed inflation differentials mean that the pace at which the rupee will depreciate on an annual basis over a long period of time, does that expectation move from, say, 4-5% to 2-3%? We'll know only in retrospect, but some of these fundamentals are actually supportive, at least of a stable currency. I'm not saying it's going to appreciate or depreciate, but a slightly more stable path for the Indian rupee perhaps in the offing.
Interesting that, Ira. And connected to that, there's a warning that's coming from the US debt market. The 10-year Treasury yield has fallen below the 3-month yield for the first time since 2007. Historically, the inversion of the yield curve has been followed by an economic recession within 12 to 18 months. Bloomberg's Lisa Abramovich reports.
Let's take a look at what's been driving this yield curve flattening. It really comes from the 10-year, not the 3-month T-bill. If you pull up this chart, you can see that 10-year yields have absolutely plummeted over the past few sessions to the lowest levels in more than a year, while those 3-month T-bill yields keep rising. So this really is being driven by something else. If you flip up the board, you can see that spread. This matters because people typically look to this curve, including the New York Federal Reserve, as an indicator of recession risk. In other words, if this inverts, that usually does signal that there is an economic downturn in the next 12 to 18 months. The question is why? Is this because of the Fed? Is this because of something else? And the answer is it's something else. It's not the Federal Reserve. They've actually come out, been extra dovish. This is really coming from lower inflation expectations over the longer term. This is a gauge of inflation over the next 5 to 10 years based on break-even contracts. It saw its biggest one-day drop today, going back to August 2016. So really what we're seeing today is a repricing of inflation expectations going forward, especially given the weak PMI data out of Germany. And of course, the Federal Reserve taking a very dovish stance, making people wonder, what do they know that we don't?
Jet Airways promoter Naresh Goyal may be out of the company as chairman if that's the decision that's taken at a board meeting today. That's only one of the issues that is up for debate, whether Etihad stays in the company or goes, whether lenders come in to buy Etihad's stake and whether they give in interim financing are some of the other questions that remain unanswered. Vishnath joining us with a recap of where things stand and what's likely this week.
Right, Ira. So last week there was a meeting between the SBI chairman and Etihad CEO where the CEOs, what we understand from our sources, that he expressed a lot of concerns with the resolution plan that was in place at that point in time. He's also said that rather than putting in more equity into Jet Airways, they would much rather prefer exiting the company altogether, considering they have a lot of issues with the resolution plan itself. Now, in the absence of Etihad, that resolution plan has pretty much crumbled, and the lenders are now sort of they have to find out a new plan within a very short time frame, and as part of that, they will also have to, or at least what we understand from our sources, is that lenders are moving towards this decision to take over majority equity in Jet Airways. Combining what Etihad owns in Jet Airways as well as the majority equity stake that the lenders would have gotten under a resolution plan, approximately their holding would be about 60+%. So obviously they will be in the driving seat as far as Jet Airways goes. What we also understand is that during this board meeting that is taking place at Jet Airways later, the understanding is that Naresh Goyal will step down from his position as chairman. So once he is out of the company, then there is a need to find a new buyer for that Etihad stake. There needs to be somebody else who will come in and pump in some equity into the company because the operations need to be stabilized. In the meantime, the bankers will have to pump in some kind of additional funding for Jet Airways in the form of some short-term loans, so that they can continue paying their employees, paying their lessors, just so that their operations don't end up, stopping because of this problem that is there in the airlines currently. Another issue is also the insolvency route. Now, that has been brought up multiple times, whether Jet Airways will go into insolvency or not. And the reason why lenders are saying no to that is we broadly understand that in a services company, the only asset that the company owns is its equipment. In the case of Jet Airways, that's the airline, the aircraft itself, and the people who run the entire airline. So if both those assets are going out of the company, currently SpiceJet is looking to hire some of the planes that Jet has grounded. Employees are also going into the other airlines. So if those things go away, then there is nothing that an insolvency program can sort of resolve in this asset. No new buyer is going to come up or offer good value for these assets. So there is a need to stabilize the operations. There is a need to keep the planes running. There's also a need to safeguard some of the employees who are there in the company still. And that's the only way that they will be able to locate a new buyer and sort of get on with life. But lenders will have to first take over the equity stake and then sell it to somebody else who might be interested. So.
Krishna, thank you so much for that. That's Jet Airways for you. Brand new vehicles gathering dust at a dealer's yard is never a good sight, and that's now come to haunt automakers and dealerships alike. Cars and bike makers have started cutting down production, realizing that sales may not pick up anytime soon. Yash Upadhyay is here to take us through some of those details of what's going on the ground. Yash.
Well, right, Harsha, actually the slowdown has been persistent over the last 6 to 8 months. We had the worst ever festive sales for most of the automakers in a very long time. And that continued in the year-end sales, which again disappointed, prompting most of the dealers to, come out with very exorbitant discounts and offerings for the year-end, for the New Year sales. They too haven't, culminated into good sales for these companies, as a result of which most of these dealers are working with extremely high inventory days. So that table should come up as well. Almost 50 to 60 days when it comes to the passenger vehicles, 80 to 90 days, as high as 90 days for some of the two-wheeler companies, and about 45 to 50 days when it comes to the commercial vehicle makers. Now, what we've done is that we've taken a ratio of the wholesale, the production to the wholesales, which most of these companies report at the first of every month. It measures the production of the car or bike in that particular month as against the sale. So a value in excess of 1 would mean that the production is more than the sales, and a value less than 1 would mean that the production is less than the sales. We'll start with the bus, trucks and bus side, which is the commercial vehicle space, and there's been a mixed trend over there. That number stood at more than 1 for majority of the year-end number, year-end months, but since then the numbers have slowly started coming off. When it comes to Tata Motors, that number hit as high as 1.2 times back in December, but it has been slowly and steadily coming off, now at about 1.09 times. For Ashok Leyland, again coming in close to one time. Moving on, for the passenger vehicle space, again, ahead of the festive season, most of the car makers, they tend to ramp up production in order to cash in on the festive sales and the year-end sales, as a result of which the numbers tend to go up more than 1. So as high as 1.34 when it comes to Mahindra, and as high as 1.13 for Maruti as well. But recently, with the high inventory buildup at most of the dealers and their inability to sell cars, they have been adjusting their production, with the numbers now coming in close to where the value is supposed to be, about close to the mark of 1. A similar trend coming in for the two-wheeler space as well, with the one anomaly being that of Royal Enfield, the worker unrest at one of its plants that resulted in a huge drop in production in the month of December. But otherwise, again, the trend is largely the same. A value of more than 1 in the year-end months is now coming close to the mark of 1.
When you speak to automakers and production cuts, what are they saying?
So Harsha, they don't explicitly use the term production cut, but there has been adjustment in terms of production. We spoke to Toyota Kirloskar, not a listed company, but a large player otherwise in the OEM space. They say that they have their plant, which produces their flagship cars, that is running at full capacity. Also, they look to ramp up the production for their plant 2, which manufactures the likes of Etios and other cars. We also spoke to one of the spokesperson at Royal Enfield. They tell us that they have, in fact, not gone into producing more bikes because their production tends to be on an order-driven basis, and whilst doing so, they have not engaged in any sort of discounting wars. Lastly, we also spoke with Honda Motorcycles, and they were privy of the issue, and they managed to, reduce their production ahead of time in order to, help the dealers as well.
All right, Yash, thanks so much for that. Production cuts by auto makers are likely to hurt auto ancillary manufacturers as well. We spoke to the president and CEO at GNA Axles. He shares his thoughts.
In domestic market, the industry is going through a lot of headwinds, so it is affecting the overall scenario by 25% clear cut, which is visible in every segment, in two-wheelers, in auto sector, purely auto sector. Even Maruti has dropped over 26% production in March to take the correction in the stocks, in the finished stocks. But this scene will continue, according to my opinion, in auto segment and CV segment in first quarter also. But on other hand, the tractor market, that is off-highway segment, it will improve from April onwards, because there is a season from April to July. There's a harvesting season, and we are getting now schedules for April production also. So there will be improvement in tractor segment, but we have no hope from auto and CV segment in Q1.
Politics. It's the last day of filing nominations for the first phase of polling today. The national parties BJP and the Congress are busy forming alliances across the country, at times in defiance of an existing partner. Take Bihar, for example. The Congress has inked a deal with the left despite the RJD voicing its reservations. The BJP has also taken a decision replacing LK Advani with Amit Shah at the Gandhinagar constituency. It's also denied Shatrughan Sinha a ticket from Patna Sahib, replacing him with Union IT Minister Ravi Shankar Prasad. Will these decisions prove enough for either national party, or does the Mahagathbandhan stand a chance? Vinod Sharma, political editor at Hindustan Times, now joins us. Mr. Sharma, thank you so much indeed for joining us. We have seen both these parties announce their list of candidates, stitch up alliances. How do you think they fare, at least from forming alliances at this juncture?
You see, I think it's early days still to sort of make a perfect on-the-ground comparison because entire candidatures have not been announced. Majority of them have been announced, and majority of the alliances have been stitched up. And we may hear some more about alliances insofar as opposition is concerned. But, well, they have been little slow on the takeoff, but they are still at it. You see, we have to understand the situation in the context of 2014 as to what was the situation in 2014. In 2014, the opposition was badly splintered. The Congress had no fight left in it because it lost 3 elections, the elections in the very states that it has won this time. And it did not put up a robust fight on the ground. In fact, I often say that the Congress in 2014 did not even fight for an honorable defeat. But today the situation is different in relative terms. I'm not saying it's a perfect situation for the opposition, but it is very different from 2014. Opposition is relatively united. The Congress is relatively upbeat. And the BJP, despite what the gains it may have had on the ground on account of the recent face-off with Pakistan, still is not in a position perhaps to repeat 2014 in terms of a simple majority of its own in the Lok Sabha, which was 282 seats. So that is where the contest lies. The big question for me is whether the BJP, despite being the single largest party, if it is the single largest party, will have a majority of its own. And if it doesn't have a majority of its own, what kind of a government will that be which the BJP will lead? It's a minority government.
Okay.
And whether temperamentally the current BJP leadership can lead a minority government. That's the big question for me.
Okay, Mr. Sharma,
it is a minority government.
I was just looking at the list of names that have been announced both by the Congress and the BJP. The BJP, as I understand, has fielded about 146 new faces. The Congress has done slightly better with about 150. Anything that stood out in the names that have been announced so far for you?
Of course, I mean, we are going to have Mr. Amit Shah contesting from Gandhinagar, which was a traditional LK Advani seat. BJP won this seat for about 8-9 elections in the past. This seat was also contested and won in 1996 by Mr. Vajpayee, after 91 victory of LK Advani. And Mr. Vajpayee then gave up the seat and there was a by-election and the BJP retained the seat. So Mr. Amit Shah's candidature from Gandhinagar I mean, I have actually written it myself that, if Mr. Modi returns to power and is Prime Minister again, then Mr. Amit Shah will most certainly be LK Advani too of the BJP, because in terms of the power that he wields within the party and the government, it is almost similar to the power Mr. Advani wielded as Home Minister and Deputy Prime Minister under Mr. Vajpayee. And he was the organization man, as is Mr. Amit Shah, and the popular face was Mr. Vajpayee, as is Mr. Modi. So this, for me, is a very interesting candidature. I also would want to know whether the Honorable Prime Minister would be contesting from the second seat the way he did in 2014, Banaras and Vadodara, and whether Rahul Gandhi will also go in for a second seat somewhere in the south. These are the two very interesting elements that I see. Otherwise, the candidatures are there. You were saying that Congress has fielded relatively more new candidates. Well, new in the sense that Congress was 44 seats.
They have no choice.
So they had to set up new candidates. And the BJP setting up new candidates means that in their assessment there is strong anti-incumbency against incumbent candidates. And I see more of newer faces in Uttar Pradesh, where in 2014, whoever they set up won the election, regardless of merit, regardless of genuine popularity on the ground. And looking back, the performance of many of these members of parliament hasn't been all that encouraging.
Vinod Sharma, many thanks for joining us with your perspective. That's Vinod Sharma from Hindustan Times on the political situation today.
That's all the time we have in Power Lunch. Thanks so much for watching.
Thanks.